Hi everyone, it's Aleem here. In this video we're looking at exercise 5.13, but you wouldn't think it actually looking at the question because this looks like exercise 5.5. Well, let me tell you what we're going to do. I'm going to put a little line through this, like this, and we're going to say 5.13. And if we actually look at 5.13, what you're going to see is it's the same question, but instead it says do this question again, but this time using a periodic inventory system. So that's exactly what we're going to do. I think instead of showing you question 5.13, which doesn't actually have the information needed to answer the question, I'm leaving up 5.5 so you can see the transactions, and then we can talk about those. Alright, so with that being said, we need to do the journal entries for both Olaf and DeVito. Who's who? Olaf purchased merchandise from DeVito. Prepare the entries for Olaf, who is the buyer, and then DeVito, who is the seller. Alright, well that's fairly straightforward. Olaf purchased merchandise from DeVito for $12,000. Terms were 210 net 30 FOB shipping point. Okay, so we've got a situation where it's 210 net 30 FOB shipping point, which means ownership transfers at the shipping point. If ownership transfers at the shipping point, it's the buyer's responsibility to pay for the shipping. DeVito had paid $8,500 for the merchandise. The correct company paid the freight costs of $300, and we just determined that that's the buyer. Olaf Company returned damaged merchandise to DeVito and was given a purchase allowance of $1,800. DeVito determined the merchandise could not be repaired and sent it to the recyclers. The merchandise had cost DeVito $12.75. And finally, Olaf paid the amount due to DeVito in full. Prepare the journal entries for Olaf Company, and Olaf once again is the buyer, and then DeVito Company. And I should mention that one last difference between this question is that there is no part C in 5.13. All right, so let's go ahead and do this. For us to do that, let me pull up the solution here. So Olaf purchased merchandise from DeVito. Let's do that one first. We're going to debit purchases and credit accounts payable. I just want to draw your attention to something here, that we're not using the merchandise inventory account, and instead we're using the purchases account. The purchases account is being used because it's going to help us then later on calculate cost of goods sold. Instead of just dumping everything into the inventory account, we use accounts that sound like what they describe. On the 6th, when they pay for the freight, instead of using the merchandise inventory account, we're using the freight in account. And once again, one good way to remember stuff in a periodic inventory system is that we use accounts that sound exactly like what they describe. On the 8th, when we return inventory to the seller, instead of crediting the inventory account, we're going to use a contra asset account called purchase returns and allowances. So guys, if you think back to a perpetual system, the credit here would have been to merchandise inventory. Because this is periodic and we're using accounts that sound like what they describe, we're using an account called purchase returns and allowances. On May the 4th, may the 4th be with you, when we actually are paying our bill, we're going to debit accounts payable for $10,200 and credit cash. And then we move into the second part of this question, where we're now dealing with the DeVito Company, again using a periodic inventory system. On April 5th, when they make the sale to Olaf, they're going to debit AR and credit sales for $12,000. I want you to notice here that there is no journal entry for cost of goods sold. And the reason there is no adjustment to cost of goods sold is because this is a periodic inventory system. We don't know the effect on cost of goods sold yet. Remember, they're not making an update to cost of goods sold every time a transaction is happening. They don't have the technology to do it, right? So they are just, well, it's like, imagine going to Superstore, just buying some rice. When you scoop out the grains of rice, they don't know if you spilled any on the floor. They just know what's in the bag. They might even just key it in as $1.99 or whatever that happens to be, without actually paying attention to what was actually purchased. Well, then how do they know what they sold at the end of the period? Well, they know how much they had, they know how much they added to the bin, and then they can weigh what's left over, and then that difference is what they're going to attribute to cost of goods sold. On the 6th, there is no entry required. Remember that here the buyer paid for the shipping costs. On the 8th, sales returns and allowances is debited for $1,800. AR is credited for $1,800, and that's to record the goods that were returned to us. You'll notice here that we are not then putting this back into inventory, but even if it were put back into inventory, there wouldn't be a journal entry for it here in a periodic system. Why? And in case this is unclear, go back to the 5th. I want you to notice here that it was never taken out of inventory in the first place. That's the thing with a periodic inventory system. We aren't making these ongoing adjustments to the inventory account. On May the 4th, we collect cash. So cash goes up by 10,200. AR goes down by 10,200. And there is nothing else to do here simply because, well, that was the end of the question. Actually, what I wanted to say is the amount is not 12,000, it's 10,200. And the reason for that is because, don't forget, there were some goods that were returned to us. All right, so that's really it for this question. We've made the journal entries for Olaf. We've made the entries for DeVito. That's it for this question, and that means that's it for this video. Thanks for watching.